Welcome to Street's Spring Statement webinar. My name's James Pinchbeck. I'm the firm's marketing partner, and I'm delighted to be hosting this session where we'll review the announcements made in the Spring Statement, but also major on the tax planning and investment management decisions you may need to take in the next 12 months. The Spring Statement is supposed to be a fiscal event where the Chancellor revisits their forecasts and adjusts or uses levers to manage their budgets and forecasts for the period ahead. Yesterday, Rachel Reeves made the announcement that and announced that the growth in the UK economy was not as strong as had been predicted in her budget in November. Much of this lack of growth has been attributed to geopolitical matters, and in particular, it seems to be cited that the election of a new president, Mr. President Trump, seems to be having serious repercussions across the global economy. The impact of this and other matters has really led to a situation where the public coffers are not as full as she'd hoped, and the economy isn't growing as quickly or as much as they had hoped as well or planned, with economic forecasts being halved from 2% to 1% for the year ahead. Therefore, there were a number of measures announced, particularly around public sector spending cuts and the rationalisation and achievements of efficiencies within the public sector to balance the books. Perhaps many of you may have been disappointed on the basis there was no redress around matters that seem to have impacted businesses, in particular around the announced increase in national insurance due to come in April, and also the matter relating to the treatment of inheritance tax and agricultural profit relief, particularly in the farming sector. Over the course of this presentation, which I'll be joined by Kelly Goodchild, a Senior Tax Manager, Michael Ball, Tax Partner, and Sam Tyndale, Managing Director of Tower House Wealth Management, we will cover some of the points raised, but also particularly focus, as I say, on tax planning matters and investment decisions and financial management for the period ahead. I would stress what the Chancellor has actually given us with the announcement that she only really wants to see one fiscal event, that is a budget once a year, that we've now got 8 months of serious planning and consideration to take effect. So I'm delighted to welcome Kelly for a presentation. Thank you.
Thanks, James. Morning, everybody. As James said, there's not been much announced by way of anything changing for the taxpayer or businesses really, but so what I'm going to focus on is going over what's been announced already, what's going to come in from this April and a couple of things from next April, and then Michael's going to take over and sort of carry on what's going to happen in the next sort of 2 or 3 years. So this slide is the same slide that I used last October, just to reiterate that personal allowances are frozen, income tax bands are frozen, tapering of personal allowance is still happening at £100,000, and all tax thresholds for national insurance, employees, etc., are going to remain the same as our national insurance for self-employed. So no changes there, all the same rates, all the same thresholds. What is going to change, which I did mention last year, which I'm going to touch on again now, is the increase in national insurance for employers, which is going to have quite a detrimental effect on employee costs for businesses across the board. The previous amount, what we're paying now, is 13.8%, going up to 15%, and this applies across all Class 1 national insurance. So Class 1 national insurance on pay, Class 1A national insurance on benefits in kind, and Class 1B on PAYE settlement agreements. What's also is going to have an effect is the secondary threshold. So this is a threshold in which employers start to pay national insurance for their employees. Was £9,100, is coming down to £5,000. So it's a double whammy of rates going up, thresholds coming down. Just to work through an example, which is a pretty sort of worst case scenario, really, I guess. This would be a business employing 100 people working on a 40-hour week on a minimum wage. From April this year, the additional cost in national insurance is going to be over £100,000, and the additional salary bill for the increase in minimum wage is going to be £160,000. quite chunky, over £250,000. Now, after if it's a company, after CT relief, that would come down to about £197,000 extra costs for you as a business if that was your circumstance. So as you can see, it's going to have a massive impact on employee costs going forward. Now, the hardest hitting are the hospitality industry, which has been hard hit, obviously, over COVID and is still sort of recovering from that area, and care sector workers, which a lot are on national minimum wage. So the two sectors that it was going to hit most, really. So managing the impact. Now, Rachel Reeves said that she was not going to make any changes that were going to hit households. So she was focusing on businesses and the like, but not going to hit the household. But this actually, I think, will, because businesses are going to have to take measures and take potentially drastic action to change how they employ people in their workforce. So managing the impact of this national insurance increase could involve reducing your headcount, getting rid of staff, reducing the hours of staff, staff mixing, so taking on more part-time staff, reducing contracted hours to minimise the amount of national insurance paid, replacing labour with technology, again, you know, having an effect on the workers, holding off recruiting new staff. So all pretty negative, I would say, really. Freezing pay, freezing bonuses. Something that businesses could look at as a way of alleviating some national insurance would be, and keeping the staff and in the same circumstances, would be to offer salary sacrifice arrangements, which generally relate to pension contributions, but can be on a few other things, electric cars, bikes and things like that. But the main one is sort of pension contributions, which saves the national insurance for the employer and has tax advantages for the employee too. But this is an administration burden to add to the cost for the employer again. So also another thing would be to take on apprentices. Obviously, apprentices are lower paid, therefore lower national insurance. One thing which I don't think softens the blow particularly, really, is the employer's allowance, national insurance allowance, which was applicable to businesses that had a national insurance bill of less than £100,000, was previously £5,000, has now gone up to £10,500 from April. So this means that you get the first £10,500 basically off your national insurance bill for your employees. Effectively, that would cover the cost of 4 employees on national living wage. It's obviously every little helps. That's gone up to 10,500, and they've also taken off the £100,000 limit. So as long as you're an eligible employer, it doesn't matter what your employer's national insurance bill is, you should be able to get that allowance now. So just going over the national minimum wage, again, we mentioned this in October because that's when it was announced. So from this April, national living wage is going to be £12.21. National minimum wage for 18 to 20-year-olds, £10, and national minimum wage for under 18s, £7.55. So that's where the increase in staff costs are going up as well. So moving on now then, this is personal tax areas. So capital gains tax, in the budget last year, it was announced that with immediate effect, capital gains tax was going to go up on sale of assets. So things like stocks and shares, any assets other than residential property. The lower rate used to be 10%, and which means up to your basic rate band, you would pay 10% capital gains tax. That's gone up to 18%, so almost doubled. And the higher rate, which you previously would have paid 20%, has now gone up to 24%. So what this has done is it has brought it in line with the rates that people pay on the sale of residential properties. So that was 18 and 24, and now sale of any assets that creates a capital gain will be chargeable at 18 and 24%. Another measure brought in was business asset disposal relief. This is where you sell business assets or sell your business. The first £1 million of gain on that was taxable at 10%. And from April 2025, that's going up to 14%. And then from next April, that's going up to 18%. So I think with this, what this might do is bring forward sales of businesses, people retiring, getting out of the business a little bit earlier than they probably would have done before, because the increase from 10 to 18% is effectively double. So it's something worth thinking about if that was, you were thinking of exiting a business in the next couple of years. Stamp duty, land tax. When you purchase a second property, there is a surcharge. It was 3%. From October last year, that went up to 5%. So on top of the rates that you would already pay stamp duty, land tax on, there's an additional surcharge of now 5%. The example there is if you bought a second property for £250,000, you would have paid £7,500. Now you're going to pay 12,500. So that's gone up quite a bit. The reasons why they're doing it is effectively to encourage first-time buyers and give them a comparative advantage to buying homes. What's also, which is not on the slide, is changing, is the rates and the thresholds at which you start to pay stamp duty, land tax. So previously, up to 250, you wouldn't have paid any stamp duty, land tax on the first, if it was your only primary residence. That's coming down to 125. And if you're a first-time buyer, you didn't pay any stamp duty up to 425. That's coming down to 300. So those thresholds are coming down as well. So across the board, more stamp duty, land tax to pay on purchasing properties. Sticking with properties, the abolition of the special treatment of furnished holiday lets. So for many years, I think it was brought in back maybe early 90s to encourage the holiday industry in the UK. People that had furnished holiday lets were given quite significant tax advantages. These included things like it was classed as a business asset. So if you sold it, you would get 10% business asset disposal relief. Little bits and bobs like that. So now what's happened is they have abolished pretty much all of the advantages of owning a furnished holiday let, and now it will be classed and taxed as pretty much an ordinary residential property. So whether you're renting out a property on a short-term tenancy, or you're renting out a furnished holiday let through Airbnb, you're gonna be in the same sort of boat. So interest relief on mortgages. Now, the restrictions on these were brought in a few years ago for residential properties, but it didn't apply to furnished holiday lets because they were allowed to deduct the mortgage interest as a deduction from their profits. So they would have a lesser amount taxable. From the 5th of April, that's going to change, and they're going to be the same rules as if you owned a residential property, in that it's not a deductible expense from your income, from your property income. However, it is a tax reducer. So whatever you pay in mortgage interest, you will get at 20% as a tax reducer. So we'll reduce your tax bill. So if your mortgage interest was £1,000, you paid 200, at 20%, you'd get a tax reducer at 200. So that's going to be the case for furnished holiday lets now, which can have a detrimental effect if you're a higher rate taxpayer, because you're restricting that relief to 20%, not 40% as it was before. Losses that were made for furnished holiday lets were ring fenced. I suppose the good thing now is that you can use them against your wider property portfolio if you have other property that you rent out. Brought forward losses. So because they're changing the rules, they're giving you a little bit of leeway. So brought forward losses can also be used in this way. So they can also be offset against any other property income. They're effectively bringing the furnished holiday let, which was a separate business, into the property business. Capital allowances. Now, furnished holiday lets were able to claim capital allowances. So if you bought capital items for your holiday lets, such as beds, lawnmower, things like that, that you used in that property, you could claim capital allowances, which obviously the annual allowance for capital allowances, would cover pretty much 100% of what you were spending on that property. From April, that's going to. So unused capital allowances we can still use. You're not going to lose them. But going forward, capital allowances aren't going to be able to be claimed. No longer applies for business asset disposal relief. So as I was saying before, where you would have got 10%, which is going up to 14 now, on the disposal of that property, it's going to fall in with the normal CGT rate. So that's going to be 18 and 24. So quite a big jump there. And I think one of the things that's going to affect certainly quite a lot of our clients is how we split this income. So previously, furnished holiday lets, you could split the income how you so wished, effectively. So if you had a husband and wife owning a property, husband was a higher rate taxpayer, wife was a basic rate taxpayer, we could effectively give wife all of the income, she would pay 20% tax. We can't do that anymore. It has to be taxed in the proportion that it's owned. So if it's a jointly owned property, it has to be taxed 50-50. Now, there are ways we can deal with this. We can do what is called a declaration of trust, which is a legal document drawn up by a solicitor, whereby the husband or wife or civil partner can transfer their equity to their partner. One thing to bear in mind with this is that if you're transferring the income, you're also transferring any capital gain. So if this property was sold and there was a large gain, then you may sort of fall foul of high rates for capital gains tax potentially. If you're thinking about doing this, as I said, it's a legal document that needs to be drawn up by a solicitor, and you also need to inform HMRC of this on a Form 17. So this needs to be completed and sent to HMRC within the 60 days of it taking effect. You can't backdate the forms, but it all does need to be done properly to make sure that HMRC know and that the legal document is drawn up. One thing to keep in mind with this, however, is if you have a mortgage on that property, effectively you are giving or selling your part of that mortgage to your partner. So if you had £100,000 mortgage, 50-50, you were giving 45% to your husband, wife, partner. That would be effectively £45,000 worth of debt. So stamp duty, land tax would be taxable on that as a second property at 5%. So you're looking at stamp duty on that transfer about £2,250. So you need to weigh up the costs that it would cost to do this. Also, mortgage companies do need to be informed because you could be changing the falling foul of anything that's in the mortgage agreement. So it's an option, but it does need looking at, and it does need lots of things to be considered. So moving on now to payrolling of benefits from April 2026. So currently, if you provide benefits in kind for your employees, you report these after the end of the tax year, before the 6th of April. On a P11D, you calculate the Class 1 National Insurance due on a P11DB, and these get submitted to HMRC by the 6th of July. Class 1A paid by the 19th of July. This is going to stop from next April. What's going to happen is benefits in kind are going to be included in the payroll. So they are each month going to appear on a payslip through the payroll. They'll be submitted through the full payment submission along with the rest of the salary information that your payroll department deals with, and the tax and the national insurance will be paid in real time. HMRC have said they're doing this because they feel like it will stop any unnecessary underpayments of tax. So because your P11Ds are always submitted a year after the benefit, potentially you could have different benefits for the year or increase in private medical, things like that, which always would leave the employee with a slight underpayment. So and they're also saying that it's for cash flow purposes for businesses. So you're paying the Class 1 national insurance in the year as you go along, as opposed to one payment at the end of the year. The exception to this rule is, at the moment, employment-related loans and accommodation. So these can still be completed on a P11D and P11DB from 26. But the plan is to bring all benefits eventually into this payrolling system. So you need to be ready. Employers need to be ready. Payrolling administration processes need to make sure that the data is collected in a timely manner, in the correct manner, and so that the employees are taxed correctly in that pay period. That brings with it the increased risks of error and in turn potentially penalties from HMRC for errors and mistakes made. So the tip, you know, you need to keep your records, and you need a new system for collecting this data, which you wouldn't have had before until after the end of the tax year. You need to communicate to your employees. So you need to let them know that this is how it's going to be from April 2026 when they see changes on their pay slips. Because obviously previously, before, it would have been in the tax code and they wouldn't have seen any mention of a benefit in kind on their pay slip. So just keep them informed as to what's happening. HMRC haven't finalised the legislation with regards to this, but they have confirmed that it's definitely coming in from April 2026. So we need to gear up and be ready for it. I've just put on the bottom there, you know, if you need any help and assistance, because it is an extra burden, it is an extra administration duty that's got to be performed. If you need any help whatsoever, then obviously we've got Streets Payroll Services headed up by Teresa, who will be more than happy to help you. Final slides now are just some other bits. Vehicle exercise duty on electric cars. So I just thought I'd put this one in because from April, they are no longer exempt. So they are going to have to start paying road tax like the rest of us. There are different rates. If it's a car registered on or after the 1st of April, you'll get a first year rate allowance of £10, and then it goes up to £195, the same as all other cars. Expensive cars over £40,000, which potentially most cars are these days, aren't they? Will have a supplement of £425. So that's in addition to the 195, so 620. And then electric cars that were registered between April 2017 and March 2025 will pay £195, the same as all cars. So that's just something to bear in mind as an additional cost if you've got a fleet of electric cars, that they're going to start paying road tax now. The state pension they're maintaining the triple lock, so that's going up by 4.1% from April 2025. High income child benefit charge, this is still around. Tapering comes in now at 60, it was 50 a couple of years ago. That's gone up to 60 and completely tapers out at 80,000. So if you earn between 60 and 80,000, you're still entitled to some of your child benefit. But once you tip over 80, you're not entitled to it at all. You can still claim it, but then you have to pay it back. Now, previously, there's been a flurry of letters going out to people saying you've not included this high income benefit charge and you've got to complete a tax return, for people that have never been in self-assessment before. I think this has caused distress to a lot of people and a lot more admin for HMRC issuing tax returns to people that don't really need to be in the self-assessment system. So what they have agreed to do from now on in is collect any higher child benefit charge through people's PAYE codes, which makes much more sense because people don't need to be in self-assessment completing tax returns for just that one charge. Double cab pickups, this was announced. They've been on the radar for a very, very long time. HMRC never liked the fact that they were classed as vans and people were getting reduced benefits in kind and being able to claim capital allowances. Well, they finally changed the rules, and from the 6th of April, they no longer are classed as a van. They will be classed as a car and taxed through the benefit in kind system accordingly to list price, depending, and then the CO2 emissions, depending on what factors you are multiplied up at. So that is going to be a big change because they were all the rage for quite a long time. People were using them basically sort of a luxury cab, I guess, really double cab, but for a very small benefit in kind, and being able to claim 100% capital allowances on the purchase. Transitional rules will apply, I'll just add. So if you ordered your double cab pickup before April, then you still apply, and they're tapering it out up until 2029. My final slide is to do with penalties for late payment of tax. Now, this is basically all we've had in information, so I'm not quite sure to the extent of some of it, but certainly failure to pay your tax within 1 month is now, from the 1st of April, going to incur a 10% tax charge, 10% penalty. Previously, it was 5%. So if you had a tax liability due on the 31st of January, you didn't pay it by the end of February, you would get a 5% penalty for not paying it. That's going up to 10%, which is double and could certainly rack up to quite a large amount if you owe a big tax bill. They've also said that they're going to charge between 2 and 3 and 4 and 10%, depending on how long it's still outstanding. Now, we're not quite sure whether this is being added on to the after a month or it's previous to a month, but we'll just keep an eye out for the information that HMRC release regarding this in the next few days, because obviously if it's coming in from the 1st of April, we are on with that from next Tuesday. So that's my part of the presentation done. If you've got any queries, then please send a question in on the chat and I'll try and answer them for you. I'm going to pass on to Michael now, who's going to get into the nitty-gritty of the changes to do with business property relief, agricultural property relief and MTD, which is coming in as well. Thank you.
Thank you, Kelly. Hello, everybody. Thanks again for joining us today. So as we've already mentioned, not a great deal of announcements tax related in the spring statement, which is more how it used to be. We have got used to the last few years to having 2 statements every year that have had impacts that we've needed to report on. But this time it seemed to settle down a little bit. So what I'm going to continue with, following on from what Kelly has been talking about, is talking about the changes that were already announced either at the budget in October or that are more widely announced, and just giving a bit of a refresher on those and a bit more detail where we now have that. So to start off with, one thing that was outlined at the October budget was the corporation tax roadmap. This was to give a degree of certainty to companies over how the corporation tax regime was going to look for the duration of this parliament, effectively just stating the status quo and outlining that there's not going to be any significant changes to them over the course of the parliament. You can see there the sort of things that they were announcing last budget day. I'm not going to go through all of these now, but that's just to reiterate. From the spring statement, there was a couple of updates that affect this area. One was that there is a consultation being launched yesterday on R&D tax relief and the possibility of having an advanced clearance regime, something that may be quite useful, particularly in this landscape that we have now, where there's a lot of emphasis by HMRC around, potentially, if I can get my words out, potentially even fraud in this area and incorrect claims. So the ability to have a advanced clearance procedure may well be useful. This is just a consultation document at this stage, so it's still to be worked out in terms of the details, but something to be aware of that it may come down the road. A lot of the announcements that the Chancellor made yesterday around new spending was around defence spending and the Ministry of Defence spending, and also the announcement of a new agency for innovative technology and to get that to the front line. So if you're in that sector, there is quite a bit of extra potential funding around in that sector. So it could have some benefits to that sector of the economy at least. Also, a theme of yesterday's statement and the subsequent documents was around HMRC tackling debt. And by debt, we mean money that is owed to HMRC, but also tackling avoidance and evasion as well. There was some additional funding announced to recruit additional compliance officers. This was in addition to what had been announced in the budget in October. There was also some discussion around expanding HMRC's counter-fraud capability. They want to push the amount of fraud investigations up to try and again tackle evasion through deliberately avoiding your tax, or say deliberately evading your tax. They're also going to overhaul their approach to the offshore non-tax compliance. So effectively this is targeting wealthy individuals who try to hide their wealth abroad and don't pay tax on that income. So to give some context to that, if you are a UK resident, you have to pay income tax on your worldwide income. And that people have been trying to avoid by hiding their wealth offshore. HMRC are going to be looking at this in more detail. They're also going to be shaking up their debt management system. So there is a document providing some details on that in the budget, or in the spring statement documentation. And effectively they're just going to be really coming after people who haven't paid their tax, which is along the lines of what Kelly was mentioning earlier around additional penalties for late payment of tax. Effectively, they need every penny they can get, and they're going to empower HMRC to try to bring it in. Some other consultations that were launched yesterday was on the better use of new and improved third-party data. So HMRC are continuing to get more and more information from third parties, whether they be banks or investment houses, etc. And they want to use that information better to make sure that people are paying the correct amount of tax. There's a consultation on behavioural penalties reforms. This is again looking at the current penalty regimes around incorrect submissions and how that regime could be changed to encourage people to make sure they get things right first time. There was also a couple of consultations launched targeting advisors. One on enhancing HMRC's ability to avoid tax advisors facilitating non-compliance, and the other closing in on promoters of tax avoidance. This is continuing a trend with HMRC where they are looking at tax advisors and agents who are potentially not advising their clients in the correct way and helping them to evade tax. I think the point to take away from that is going to become more important than ever to make sure that you have a well-respected and trusted advisor who can advise you properly and not steer you down any of these wrong alleys, as is often the way. If it sounds too good to be true, it probably is. Continuing with HMRC and the changes that they are looking to implement. Again, this was announced at the previous budget, and it was also strengthened again in the spring statement. They are looking to make digital improvements. The use of digital technology to improve, simplify, just make the interaction with HMRC an easier process, and therefore hopefully reduce the amount of tax lost through errors and mistakes. So the government have announced that they want to simplify the tax administration, and they're looking for basically some ideas on this. The CIOT have launched a survey around tax simplification to help provide some information to them on this topic. One area of digitalisation of the tax system is making tax digital. So we had this come in a few years ago now for VAT. As many of you probably already know, this is coming in for income tax from April next year. It's been in the pipeline for, must be getting on for a decade. It is finally here, it is finally arriving. So there was a policy document issued yesterday which provides a bit more details on it. But as a lot of you probably already know, if you have gross rental or turnover of self-employed income above the relevant threshold, you will be brought into making tax digital for income tax. What this means is you will need to make quarterly submissions of your income and expenses to HMRC. You'll have to keep your business records digitally and make those quarterly submissions from those digital records. And you will then make a final declaration to HMRC at the year end, which is replacing the current self-assessment tax return. We now have much more clarity around the income thresholds and when these are going to come in. So for combined income from rental and self-employed businesses of above 50,000 from April 26, you will be brought in. For above 30,000 from April 27, you will be within MTD. And we now know that from April 28, those with income above 20,000 will be brought in. They had announced at the budget that those above 20,000 would come in during this Parliament. We now know from the spring statement that it will be from April 28. So this is something that is starting to come in next year, next April. But because it is such a big change around how you potentially keep your records and how you make your submissions, it's something that you need to start planning for pretty soon. HMRC have stated that they're going to be making contact with taxpayers who they believe are going to be affected in next month, actually in April. So letters should start to go out next month from HMRC. Ourselves at Streets, we are in the process of sorting our firm-wide strategy on making tax digital, and there'll be some material coming out from us in the next few weeks, hopefully, in regards to this and how we can help you. But in the meantime, if you do have any queries and think you might be impacted, then just get into contact with your usual Streets advisor and we'll be able to talk you through these changes. Final point on digitalisation, and that is around inheritance tax. This was something that was mentioned at the budget. There was nothing else announced on it yesterday that I've noted, but effectively, the budget they announced they were investing 52 million to digitise the inheritance tax system. Currently, inheritance tax is still very much a paper-based system, paper-based forms, submissions HMRC, correspondence is all through letters, and it can be a little bit cumbersome and take some time to deal with. If this does come through 27-28 and we move to a more online system, I think that can hopefully only be a good thing, assuming that the systems are up and running and work correctly. So the bulk of what I'm going to talk to you about today is actually around inheritance tax. With there not being a great deal in the spring statement around tax changes, in producing this content for this webinar, we've all been thinking about what is it that people have been asking us about over the last few months. And inheritance tax is by far the number one thing that people have been asking me about and that I've been talking about since the October budget. So I'm going to run through a bit of a recap of some of the changes that were announced in the October budget and then give you a little bit more detail where we now have it. So firstly, on nil rate bands, these have been frozen and have been frozen since 2009, and for the main nil rate band at 325,000, we know that's staying the same until 2030. The residence nil rate band has been 175 since April 2020 and will continue there until 2030 as well. So no changes on those bands. The main nil rate band having been the same, and it will have been the same level for 21 years by 2030, with property price increases over that period. More and more estates have been brought into inheritance tax. It is important to note the spousal transfer. If it hasn't been used on first death, it can transfer to the surviving spouse's estate. So if everything aligns, you can get up to £1 million to transfer to the next generation inheritance tax free, but you do have to have got everything in a line tax planning wise to make sure that works. I've got pensions on there. From April 27, we know that unspent pension pots are coming into the inheritance tax regime. That is all I'm going to say on that, because I know that Sam is going to talk in a lot more detail about that, and I don't want to steal all of his thunder on that. And plus, he'd probably be able to explain it a lot better than me anyway. So getting on to the nitty gritty, business property relief and agricultural property relief. As everyone will know, because it's been all over the press and everyone's been talking about it ever since the end of October, the rate of relief for business property and agricultural property is changing from April 26. It will become only the first £1 million of combined qualifying assets will get 100% relief. Above that, only 50% relief. This is going to have quite significant impacts both for farms and also for private businesses as well, and particularly around the funding of this tax regime and making sure that the business continues to be viable, having had to pay out for this liability. So on the £1 million allowance, so far, all the indications are that this will not be transferable to the spouse. So if you don't use it in your estate, then when your spouse passes away, they won't be able to use yours. It's gone. So either use it or lose it on this, unlike the nil rate band, which I mentioned can be transferred. This is very much a use it or lose it situation. So the £1 million for your estate covers your estate on death. So if you own agricultural land, if you own shares in a limited company, but it also covers if you have a qualifying interest in possession in a trust that falls into your estate, that comes under the 1 million. Any gifts made in the previous 7 years that you haven't survived by the 7 years, they will fall in and be utilised part of your 1 million on your death as well. So that's failed pets and chargeable lifetime transfers, such as gifts into a trust. What we do know, following a document that was released towards the end of February, is that the £1 million for individuals refreshes every 7 years. So if you make a gift and then survive that gift by 7 years. So if that gift uses your part of your £1 million allowance, but you then survive that gift by the 7 years, your £1 million allowance then refreshes. So your estate will still then have the £1 million. So that does give the opportunity for some planning, for long-term planning, if you're young enough to take advantage of it. So for points on inheritance tax, lifetime gifting, as was perhaps to be expected, the budget day they did realise that as they were giving a window of opportunity before this new regime came into effect, they brought in some forestalling provisions. So if you make a lifetime gift on or after the budget day and you die within 7 years and that death falls after the 6th or on or after the 6th of April 26, these new rates of relief will apply. So you can't get away from it just by gifting all of your relievable assets now. Trusts and the £1 million limit. So we had some details of this at the budget, and then we've got some more details that came out from a consultation at the end of February, and I'll be covering those details in a moment. For trusts in existence before the 30th of October, we already knew that they would each have a £1 million allowance each. So if you'd already done some previous lifetime planning by setting up trusts, that has still been beneficial, but perhaps quite not as beneficial as it was originally. And for those trusts set up on or after the 30th of October 24, we knew from budget day that they would share an allowance, but we didn't know how that was going to work. We do now have some more details, and I shall come on to those in a minute. And we also found out that the APR regime has been extended to land in environmental land management schemes from April this year as well. So that was good news. Something that we largely expected, but we didn't have confirmed for definite. So that was something good from the last budget. So I'm going to cover some details on trusts now. It does get complicated, and I'm only going to run through it fairly quickly and in brief. And what I would say on the trust side is that they have got a lot more complicated since budget day and since we've received the details in the consultation. So if you have an existing trust or you're considering any trust planning, you really do need to take professional advice. You needed to anyway, but now with these types of assets, it's even more important because they are very complicated now. So existing trusts, i.e. those before the budget, so they will be within the new regime from their next 10-year anniversary after April 26. Exits from that trust can continue to benefit from full relief until the next 10-year charge. So that does actually give us a window of planning for existing trusts. And the relief, and on the next 10-year charge, when the new regime does kick in, there is going to be some relief to mitigate the 50% relief value for the period that the trust is in existence before the April 26. So there is some relaxations there around existing trusts just to smooth out this transition for them. For trusts set up between October 21 and 5th April 26, you can settle into a new trust and get 100% relief, not subject to the £1 million cap. Exits before April 26 can also continue to benefit from that 100% relief. So again, a little bit of a planning window there. But then from April 26, they'll be into the new regime. And again, there'll be some relief on the next 10-year charge. And then for trusts set up post 5th of April 26, the settlement into the trust will be subject to the £1 million allowance of the settler, which again refreshes for the settler from the date from after 7 years. And all subsequent 10-year charges and exit charges for those trusts will be subject to the new regime, being potentially up to £1 million at 100% and 50% thereafter. To stop people setting up multiple trusts and benefiting from lots and lots of these £1 million, they have brought in some rules that will effectively mean that trusts set up after the budget day will share the £1 million allowance. We do have some more detail on that now. So the way it's going to work is you set up trust number one after budget day, put in, for example, £750,000 of relievable assets. That trust will then have an allowance of £750,000 for its duration. The second trust, say if you waited 7 years and then set up another trust, settled another £750,000 into that trust would only be able to have £250,000 relief for its duration because it only has what's left of that £1 million to be shared between the trusts. I really have whizzed through that bit on trust. As I say, it's very complicated. Do speak to us if you have any issues or concerns or want to consider some planning in that area because it has got very complicated now. Some matters to consider around inheritance tax. Planning now is partly, or some might even say largely, around maximising the £1 million allowances that we've got to play with. This may mean transferring some assets to spouse to ensure that both of you can use your £1 million because, as I said, if you don't use it, you lose it. So depending on the order of death, if you haven't got the assets in your estate that can use this allowance, but your spouse has more than £1 million, we might be missing some optimization of your tax strategy there. You need to consider reviewing clauses in existing wills. Are they drafted to make sure you use your £1 million? If you've got relievable assets, but your will says everything's spouse on first death, you're potentially wasting your £1 million worth of relief. So that needs to be considered. And we do need to consider the use of new lifetime trusts. Yes, there are provisions to stop you multiplying the million, but by having a new lifetime trust and surviving by 7 years, you have generated an extra £1 million at 100% relief. So it's well worth considering. You also need to consider how the liability will be paid. So whenever we start planning around inheritance tax with clients, it is always very much a case of let's quantify the problem. That's where we need to start. If that liability is potentially insurable against, is that a cost-effective way to go about paying the inheritance tax liability and minimising the amount of planning you need to do? It's something that needs to be considered. And where does the tax burden fall in your will? If the tax burden all falls on the residue, but the residue is passing to a different beneficiary than the relievable assets, which now generate a liability, is that still the way you want your will to work? Do you need to reconsider how that tax liability falls in your estate? We need to consider existing trusts. Is there a potential for some planning before their next 10-year charges? Does the trust still serve its purpose? Is it worth getting the assets out? Is it worth keeping it, but just thinking about how we're going to fund the liability on those subsequent 10-year charges? And also deaths that have occurred in the last 2 years. It might be that on that death, everything passed to spouse, but they have relievable assets. Do we need to revisit that will, consider a deed of variation to actually bank the business property or agricultural property relief that was available in that estate, but we didn't use it? All of these things are things that need to be considered over the course of the next few months, year or so. There's a lot of work to be done, a lot of planning to be done, but there are some ways to improve your overall tax position for the family. My final slide before I pass on to Sam is around the changes to non-domiciled individuals and how this could impact. Again, this is an incredibly complicated area. We do now have a lot more detail on this area than we did immediately following the budget. If you have any indication that you think you may be caught by some of these changes, and remember these changes, whilst they are based around the abolition of the non-domicile regime and moving towards a residence-based regime, both for income tax purposes around remittance basis being removed, and also inheritance tax from moving from a domicile-based system for inheritance tax and deciding which assets of yours are actually subject to inheritance tax, whether it's just your UK-based or your worldwide, moving from a domicile system to a residency-based system. Whilst it is around the non-domicile abolition, it still has implications for those who may become resident in the UK or may become non-resident in the UK. And now that we've got some more details, we are able to actually help guide clients through this regime. There are some winners as well as some losers out of these changes. They are complicated, so please make sure you do make contact with us and we can look to help you on this matter if you think it affects you. That's all I've got to say. So I'm going to pass on to Sam, who probably amongst some other things is going to talk to you about inheritance tax on pension pots. Thank you.
Thanks, Michael. As you correctly say, the crux of this presentation is really going to be focused in on the IHT treatment and changes to pensions. Before I start, I think the most important thing to state, whereas Michael might have had some clarity from the consultations that have taken place, unfortunately for financial services, we are still very much in limbo. We know these changes are going to take place to pensions from April 2027. However, we haven't yet had any more detail. Following the budget, there was a consultation that took place through to the end of January 25. And the outcome of that consultation is we have to wait a little bit longer to hear the outcome of that consultation. So we're expecting to hear some more detail by the end of this year. However, the Pensions Minister was asked the other day at a conference if they were still planning to go ahead with the inheritance tax on pensions, and his response very much indicated that they had no intention of not going ahead. The consultation is simply to understand how best to put this into practice. As I think was spoken about in October, part of the practical difficulty here is that if you bring pensions inside the scope of inheritance tax and you expect your pension provider to take that inheritance tax bill, that's going to cause a massive delay to probate cases, and a pension provider isn't going to know whether they need to deduct inheritance tax from a pension pot without knowledge and visibility of all the other assets. So it will delay what is quite a quick process at the moment in terms of distributing pension death benefits, and likely to make it a lot more complicated and drawn out. Just starting with a really basic background to inheritance tax. I appreciate Michael has already touched on this, but the importance of just understanding how this is sort of calculated then leads on to where pensions sit and how this changes. So we always like to try and keep things really basic with clients and say that as a married couple, generally speaking, you're allowed about £1 million worth of stuff before you start to pay inheritance tax. So part of that's a provision specifically to your main residence, and then the other is to other things: cash in the bank, other properties, stocks and shares, whatever it may be. And really, once you start to go over that £1 million threshold as a married couple, that's where inheritance tax starts to kick in. And then there's another barrier which we sort of try and pay attention to, and that's the £2 million or above estates, which is where we start to lose some of our inheritance tax allowances. So to keep things really basic, you're allowed £1 million worth of stuff, but if you've got more than £2 million worth of stuff, you start to lose a bit of your £1 million worth of stuff. So we try and pay a lot of attention, obviously, to any estates that are applicable to inheritance tax, but particularly for those where estates go above £2 million, because with good planning, you can gain some of those allowances back. And that's specifically losing that provision that you're allowed towards your main residence. And so at the bottom of this slide, as it confirms, pensions will now be included in the estate from 2027. As Michael's already touched on, you can pass your pension to a spouse, and that won't cause inheritance tax. This will solely be when we're sort of leaving a pension on second death, or if you were leaving a pension down to children or other beneficiaries. So the interaction between pensions and inheritance tax, and you'll notice there's asterisks here all over the place, because obviously, again, this is all subject to consultation. This is based on what we've seen so far and what we think the likely outcome is going to be. So that £2 million threshold that I mentioned a moment ago, where you start to lose some of your allowances, we believe that pensions are likely to be taken into account for that, which will be particularly bad because, you know, an estate that's maybe got assets of £1.5 million and then there's £1 million pension, not only will the £1 million pension be included, but that will then take the estate over £2 million and start to cause further actual implications for the other assets of the estate. So again, you know, we're really going to have to pay close attention to this. Pensions may be subject to a double taxation. This point, again, still isn't clear, but at the moment, death post age 75, your pension becomes taxable to income tax. So if I die pre-75, my pension is income tax free to my beneficiaries. If I die post 75, my pension is subject to income tax. Now, the biggest risk here is we end up in a world where post 75, we've got both inheritance tax to pay at 40%, and then whatever would be left over would then potentially be subject to income tax. So if we take £1 million pension, £400,000 goes in inheritance tax, the £600,000 remaining pot passes to a child, and then that child decides to cash in the pension pot in one go, and they could potentially be subject to another 45% tax on that encashment, dependent on their rate of income tax. So in that scenario, you can see it's fairly horrific numbers. Obviously, that's a pretty extreme example, and with good planning, you know, even simply looking at that example, you know, you wouldn't tell somebody to encash that pension pot in one go, you know, potentially leaving the pension pot to a lower taxpayer, you know, drawing that pension out over a period of time. There's some simple things that can be done to try and minimise that taxation, but the point is it's a step change from where we are at the moment, and our understanding is that this double taxation point looks like it could be coming in again by the end of the year. We should really have clarity on that. It'd be nice to think that it'd be one or the other between inheritance tax and income tax, but we'll have to sort of wait and see for the end of the year. And then a final point on there, that commercial property, which has long been sort of a favoured asset class of business owners. If you trade from an office, business owners have often considered using pensions, SIPs and SSAs to buy commercial property, and there's a strange interaction between all of these rules. So touching on a little bit of what Michael said about business property relief and having assets in a company versus inheritance tax on pensions, these rules could lend themselves that it's actually less tax efficient to have a commercial property or land held in a pension scheme than it could be to have it held through a limited company, a trading company, an investment company. Again, we need some confirmation there, and advice is really going to be on a case-by-case basis. Where does this leave pensions? So I think, as Michael alluded to, we've tried to approach this presentation from the perspective of what our clients asking us. And obviously, I think at the minute it's fair to say that everybody wants answers. The difficult thing as any advisor is that we are still awaiting these rules. So I would say we can give an indication to things we might be able to do. We can give an indication of where it leaves things at the moment, but again, it is all subject to confirmation. So my view and my favourite question from clients at the minute are pensions still worth it? And the simple answer for the majority of people is yes. Whilst they've placed pensions inside the scope of inheritance tax, we've got to look at this from a perspective of a government that don't want pensions to be used as a vehicle for inheritance tax planning. Now, if your pension's being used to give you an income during your lifetime, it's used for your retirement, it's still a perfectly good tax planning vehicle, and actually a very, very tax advantaged vehicle. So obviously we work with a lot of owner managed businesses. So whatever pensions remain corporation tax deductible, they're going to remain an extremely attractive way to extract profits from businesses, and especially with corporation tax at sort of higher levels than ever before, the potential to get a 25% corporation tax saving by making pension contributions makes them very attractive to a business owner. And also with corporation tax being banded, it gives an opportunity to potentially use a pension contribution to lower the rate of corporation tax that you're paying as a business if that reduces your marginal rate of profit. So they've got a really good home in businesses. And the same for individuals. The income tax benefits are still there. And largely we've always said, if you're a higher or additional rate taxpayer, pensions are really attractive. If you're in that bracket where you lose your personal allowance of income between sort of 100 and 130,000, they're really attractive there. If you're a basic rate taxpayer, the consideration between pensions and other vehicles might be a little bit closer. But again, that's why it's best to sort of speak to your advisor on those points. But they certainly haven't suddenly fallen off a cliff as an option. And probably particularly for those who pay higher income taxes and for businesses, they still remain one of the top options in terms of tax savings. Again, fundamentally, if you think about, just sort of planning we've gone from, building up a pension pot and it being the last asset that we would access in retirement to probably turning that sort of 180 and saying, well, actually, if you build up a good sized pension, we then want to be using it and spending it in your lifetime and maybe doing planning with the other assets that you hold, like business and property and shares, for example. Tax-free cash remains the same, so there's a sort of cap there for most people of about £268,000, £1.1 million of pension. So up until that point, again, they still remain really attractive. My question would be, again, for people where they've got particularly large pensions, when you're heading up to that limit of sort of £1 million of pension, you certainly want to be asking more questions at that point, as opposed to just sort of plugging away and thinking, this is still the best thing to be doing. You want to be engaging around those areas. The annual allowance remains at £60,000, which is, more generous than ever. I'm really surprised we haven't seen a reduction in that space, because it would be a quick, easy win for the government. So, sort of taking advantage of that, where income is there to do it, capital's there to do it, profits are there to do it. We don't know where the rules are going to be in the future, so take advantage of the ones that we've got at the moment. Practical ideas for those, again, thinking about what the client's asking. I appreciate if you're sort of getting older and inheritance taxes become the main topic. What can you be doing? Again, wait till the end of the year to know for sure, but some simple things that we expect to do if the rules come in as we think they will. So gifts out of excess income. So this has always been an area that's been available, which is if you've got income coming in £70,000 a year, you spend £40,000 a year, and you've got an excess income of £30,000 a year, you can give that away year on year to your beneficiaries. And as long as it's habitual in nature, it's always done, and it doesn't deprive your standard of living, there's no 7-year clock attached to those gifts. They're instantly outside of your estate. So for those where they've got higher income than they need, simply giving income away is a way to reduce or stop your estate from getting any bigger. Where we think this might interact with pensions is that, if you weren't going to draw your pension, you've got a large pension, you don't need the income. Well, all of a sudden, if you can start drawing an income from that pension and giving that income away, we're hoping that that will qualify as a gift out of excess income. But again, we just need to see where the rules land on that. Consider drawing your pension up to high rate each year. So, if you've got a decent sized pension pot at the minute, you're only drawing a very small amount out. So, say you've got £10,000 a year of income, really it would be illogical not to take advantage of your full basic rate tax band. If these rules come in, it would be much better year on year to be drawing out £50,000 a year from your pension into your estate, where you've then got options and things you can do with that in terms of gifting, in terms of putting it into trust. I think the worst scenario is that you sort of do nothing, and 10 years down the line, you go, actually, I want to take a £400,000 withdrawal out of a pension, and all of a sudden you're subject to a load of income tax in 1 year, as opposed to just drip feeding out, a small amount of income every year, year on year. So I think taking advantage of your income tax bands and being able to extract profit, particularly when you're under state pension age and you've got that full income allowance available to you. So drawing out income is not a bad idea, but what we don't want to be doing is drawing out into higher rate. We sort of try and plan most clients' lives to avoid paying higher rate tax where we can, and the same for retirement. We want to try and maximise basic rate tax and avoid higher rate. One consideration could be, though, if you were drawing £10,000 a year into high rate, so say you're drawing out £10,000 from your pension, you've got other income of £50,000. If you then took that income that you received, that you've paid high rate tax on, you can pass that to a child or grandchild who is also a high rate taxpayer. If they're able then to take those funds, invest them in a pension in their name and reclaim the higher rate tax relief, as a family, you've managed to maintain a sort of tax neutrality. Yes, you will have incurred the higher rate tax, but then, your children or grandchildren will be claiming that back. And I think this idea of sort of intergenerational planning and talking more with kids about planning, this is where better ideas are going to come from. But that's just another small example. Excess income to fund insurance, I'll come on to in a moment, and Michael touched on as well. And then the other question, tax-free cash. Obviously, you can still take 25% of your pension tax-free. If you are getting later in life and you've got uncrystallised pension funds, you've not had your tax-free cash, definitely consideration to draw in that tax-free lump sum and either gifting it or potentially placing it into trust. Anything to effectively remove 25% of that potentially inheritance taxable pension pot out of your estate. So again, just drawing it and putting it in the bank is not going to achieve anything. It's left hand to right hand, but as long as we take that and do something with it, there's some good practical solutions, which again, at least then we're only talking about 75% of the pension pot being inheritance taxable. And then my personal favourite, again, we deal with a lot of business owners, is that if you have got family involved in your company and you're taking out pension contributions each year and you've got decent level of pension behind you, actually stopping and thinking, is it right for you to have the pension anymore, or could you start paying directly into your children's pension scheme? So if they're in the business, if your children are directors, and that pension could be part of their remuneration and it's appropriate for tax purposes, it's still corporation tax deductible for the business. All you're really doing is, instead of taking it to yourself, where you've already got, what you need, potentially then getting down the road and going, I've got too much, I'm going to be subject to inheritance tax. We're just sort of skipping that generation and getting it straight down to the children, which will avoid the inheritance tax being payable, but also still achieve the corporation tax savings. So again, just little ideas that we can sort of practically approach. Another one that was mentioned on the previous slide, but I just thought I'd sort of pick it out on its own. We know, insurances aren't people's favourite and first choice. No one rushes to want to pay for insurance in life, but actually, when it comes to inheritance tax, insurance has got a place. Whole of life cover has been around for a very, very long time, and effectively, this is just insuring against your inheritance tax liability. So as Michael said earlier, we calculate your estate, we work out what your liability is, and then we get a quote for insurance to cover that liability. Something happens to you, the policy pays out to trust, and then that is used to pay the taxman so that your estate can be left intact. And that can be particularly useful practically speaking, as Michael said, you know, who's paying the bill, you know, who's had those assets, where's the liquidity coming from? If it's a family farm or a property portfolio that we want to try and keep intact, you know, insurance can be a really good idea. The main downside is that, you know, they are expensive policies, that we expect the premiums to be higher because they're guaranteed to pay out as long as you keep paying them. All you can really do is assess it in your own planning. Interestingly, the younger you are when you look at these types of insurances, the cheaper the premiums are like to be. So, you know, it might seem alien to be considering inheritance tax planning in your late 40s or early 50s, but actually starting to look at these things earlier can pay dividends down the line. There's different options with insurance between guaranteed premiums that never change and cheaper policies that get more expensive over time. But again, it's a case-by-case basis. The other just final point on there is that when we take tax-free cash from a pension, we have got the option then to fund a trust with that. And there are certain trusts out there that once you've funded a lump sum into them, that trust can then be used to pay for a whole of life insurance policy. So if your objective is out and out inheritance tax planning, you've got a lump of money there, you've not used trusts in your planning before, there's potentially some very impactful options. But again, sort of not off-the-shelf solutions. My sort of final point really, SIPs and SSAs. So as I touched on earlier, you know, long been a good vehicle to buy commercial property within a pension scheme. The rules are still not clear here. There is potentially going to be a scenario where holding your commercial property in a business will offer some relief to inheritance tax versus holding it in a pension where it'll offer no relief whatsoever. I would just suggest if there's anyone in the middle of those transactions at the moment, that it's really worth just taking your time to sit down and talk to someone and really see if it is the right thing to be doing. There's also the potential, again, as part of wider planning, that it might be that not necessarily trading companies, but investment companies could be more flexible in terms of passing on that property in the future. So just you know, for those in that position, sort of pause for thought there. That's everything from me. I'm just going to hand back over to James to finish off. Thank you.
Thank you, Sam, and thank you, Michael and Kelly, for some really detailed presentations and some really sound advice in those presentations. Conscious we're slightly over. We're not quite double the time the Chancellor took yesterday in presenting the Spring Statement, which was actually 37 minutes. The handouts are available, and that includes the presentation and upcoming changes to our IHT and APR, and also a guide to the Spring Statement. I think the takeaway for me is we've all got 8 months to plan and think about things. How do we maximise what we've got, and how do we protect what we've got? And certainly we can probably expect some tax rises if we are only relying on the house builders to build more houses, and the defence industry for innovation in defence. And the tax rises may come in the shape of that, or they may come in the shape of the continued freezing of allowances or the reduction in reliefs. May I again thank our speakers. Thank you for joining us, and we look forward to you joining us in future webinars. Thank you.